probably the biggest event of last year. And that was something that went largely unnoticed by the mainstream media. Heads you lose, tails you lose. And it's talking about this right here. And in essence, what they're saying is, if you envision your assets in the shape of a pyramid, the way the Swiss do, the base of your pyramid, which should be 60 or 70% of your assets, should be things like a paid for.
Well, hello, everyone, and welcome back to Risk. I'm Lee, and I have a great guest with me today, Mr. Andy Schectman. Andy, how you doing?
Happy New Year, Lee. It's great to see you again. It's great to be here. It's been a crazy 2021, and excited to talk about that and what we see coming forward in 2022, but I'm really glad to be here. So thanks for having me.
Sure. No, it's great to have you here. You're a longtime insider into the precious metal space. So I'm most curious to get your outlook on how things you think will unfold in 2022. Sure. We're coming up on the 1-year anniversary of the silver squeeze. So it should be a certainly interesting year.
Yeah, boy, do I remember that. That was one of the craziest weekends of my life. And I'll never forget it, but part of me feels that was just the opening salvo, if you will, as to what we can expect moving forward.
Yeah, no, I agree with you. I think the fundamental case has been growing since we left the gold standard back in the 70s, and it's gotten more and more every year. And it kind of reached a low point in the 90s when we had that ridiculously low price, which I think everyone's regretting not buying more at that time. But I think the fundamentals have really increased to the point where it's just inevitable in a short period of time.
Absolutely. No, and I completely agree with you. We just reached the 50-year anniversary last August of that Nixon closing the gold window. And if you look at what's happened to the dollar since 1971, it's lost about 99% of its value. And that's what happens when you make real money fiat. And, you had since 1974, what has made the dollar the world reserve currency and given it its stability is the protection of the Saudi kingdom. Let's not forget to talk about what I believe was probably the biggest event of last year. And that was something that went largely unnoticed by the mainstream media. And that was the day we left Afghanistan, about a month after that anniversary, or a few weeks after the anniversary of Nixon closing the gold window 50 years earlier. When we left Afghanistan unharmoniously, we get an admission from Saudi Arabia that they'd signed a joint military cooperation agreement with Russia. The next day, Russia did the same thing with Nigeria. And the next day, Russia came out in a Zero Hedge article saying that they've outfitted their nuclear submarines with the hypersonic ICBMs, which circle the globe in a matter of hours and hit the ground at the speed of an asteroid, where the State Department came out and said, we're very concerned that North Korea, that China and Russia have this technology and that we do not. This was their way of saying, don't even think of messing with us the way you did Saddam Hussein and Gaddafi, who both threatened to sell their oil in euro. You now have what is really given the dollar its world reserve standard as protecting the Saudi kingdom. You have another big kid on the block, a nuclear power, Russia, now protecting the two biggest OPEC producing countries in the world, Saudi Arabia and Nigeria. And you know what, Lee, if we woke up one morning to find an admission by the Saudis that, hey, we've decided after watching what's happened to the dollar and to the treasury market to actually open up oil and other currencies overnight, it's game over. And I think when we talk about 2021, I would be remiss if I didn't say, hey, this might have been the biggest event that we've seen in a very long time. And for my money, probably the biggest event we saw in 2021 altogether.
Yeah, and it's completely under the radar, as you said. I think even the financial analysts probably just missed it.
Yeah, it's a big deal. It's a very big deal. What has given the dollar its hegemony around the world is the fact that the Saudis, as per the agreement in 1974 between Kissinger and the Saudi kingdom, said, we will value oil through OPEC globally in dollars. You protect us. Well, now they're being protected by Russia at the same time. They could come out very quickly and say, well, we've decided to open it up to other currencies. And when we talk about an inflationary environment like we have right now, if the rest of the world said, you know what, we're going to sell dollars and buy oil in other currencies, maybe even our own, it would be a tsunami of dollars coming home when we least need them, creating a massive hyperinflationary event. And maybe this has something to do deep down with the admission by the Fed that we just saw yesterday out of their FOMC meeting minutes, which more or less seems to signal a defending of the dollar at the expense of the markets. And we can talk about that too as well.
What's your take on the markets? I mean, they just kind of seem to be chopping along. ARC is down significantly, which I think points to a shift, if you will.
Well, what we saw recently was the Fed come out and say, we're going to taper. And that should not be misconstrued at all with what just came out of the December minutes that were just published. If you look at the bond market, the 1 and the 2 year Treasury reacted to the Fed speak that they're going to taper. The long end of the bond, the 10 and the 30 year, didn't budge a bit. That's the bond traders' way of saying, we don't believe that this is something that will be substantive, that they will try to raise rates slightly to buy less, which what taper means. It doesn't mean stop, it means to buy less, and that it will affect the short term. But when the markets start to convulse, when we see a taper tantrum like we did in 2019, where the S&P falls by 17% in a few days, that on the heels of the repo market crisis, that the Fed will reverse course and in fact become more accommodating and double down on their efforts to stimulate and to keep interest rates low, and go back the other way. And the minutes came out yesterday, and basically what we saw out of the Fed meeting minutes was that you had a unanimous decision by all the Fed governors that they were not just going to taper, but they're going to double down their tapering efforts. And that by March, where they really caught the market off guard, is that the market thought they were going to taper, then raise rates, and then sell off their balance sheet. What the minutes actually say is that by March, they're going to not only taper, but double down the speed in which they taper to completely end asset purchases. At the same time, they want to raise rates, and at the same time, they want to start to sell off or normalize their balance sheet, and at a speed greater than we saw in 2017 and 18, when they did this, raised rates and lowered their balance sheet at the time from $4.5 trillion to $3.75 trillion, not even $1 trillion. And the market started to throw up. They immediately reversed course. This is what the bond market has been seeing, figuring that it was just a head fake, so to speak. And instead, they doubled down and they raised their balance sheet from that period of time, from 2019 to where we are now, from 3.75 trillion to 8 trillion. And with a tremendous amount of accommodative monetary policy with stimulus and low interest rates, and in essence, free money that has allowed the hedge funds to borrow money at next to nothing, plow it into assets, drive the asset prices up to unrealistic levels, make a ton of money, cover those loans with no problem at all, and create difficulty in price discovery, almost impossibility. And it's created a really bad situation. There was an article today in Zero Hedge titled "Heads You Lose, Tails You Lose." And it's talking about this right here. In essence, what they're saying is, if they allow the market to continue on the path that it is going, we reach hyperinflationary problems. You destroy the dollar. If they reverse course, like they are signaling they are going to, and you see them stop asset purchases and in fact sell off their balance sheet and let interest rates rise, you will blow up the markets, creating in essence a depression, maybe the greatest depression of all. And I think this is what the market has been reacting to. The question is this a head fake? Are they going to sacrifice the markets at these sky high valuations to protect the dollar? That is what they are signaling. Now, when we talk about those markets, Bank of America came out recently and said on their flow show report that in 2021, $90 billion worth of money went into the equity markets. And that is $1 billion more than the previous 19 years combined. Here are the hedge funds plowing money into the stock market, record margin debt, where people just simply believe that they can, if you have, let's just clarify this. Let's say you have $100,000 in a brokerage account. You can margin, let's say $40,000. It's borrowing against your equity. Well, people are borrowing against their equity to plow it back into the market. To give you a reason why they would do that, I live across the street from one of the largest money managers in Southern Florida. Went out to dinner with them, and I was really reserved in the way I spoke to him. I wanted to hear his side of things more than what I had to say. And he basically said to me, yeah, the markets are overvalued, but if they fall, I'll just double down because they continue to move up. The Fed won't let the markets collapse. And that's been the recipe for success for, since 2019, for sure. You could argue since 2008.
You could argue since 1980, really.
Yeah. Well, and it's worked, right? It's worked until it doesn't. And so when you see record margin debt, when you see 19 years worth of inflow into the market in 1 year, when you see massive stimulus and low interest rates and all of these things that have created this environment, we are at a point now where the rubber meets the road. Are they going to destroy the currency and create a hyperinflationary, maybe stagflation, a hyperinflationary environment? Or are they going to defend the currency and blow up the markets? Either way, something has to be done. And the market has been reacting over the last 2 days to the minutes, which basically intimates that that's exactly what they're going to do. They are going to defend the dollar, and they're going to not only stop tapering or double down tapering rather, but stop asset purchases altogether and sell their balance sheet. So you're talking pricking a big hole in that bubble. And when you talk about, their comment of 8 rate increases through the next 2 years, pushing rates at least to 2%. Anyone who's been in real estate long enough knows that a 1% rise in interest rates correlates to up to a 10% drop in real estate prices. So in that, if we believe them and take them at face value, you're talking in 2 years, rates up to 2% from the 0.25% we see right now on the Fed funds rate, which would correlate into a 20% at least drop in real estate prices. And how many people, myself included, over the last 2 years have bought housing at really all-time highs. When you see a normalization of interest rates, that's going to have a massive effect. And look, 2% is really very low, especially when you look at the CPI numbers at 6.8%. Even at 2%, we're a long way from that. That would be a 4.8% negative real yield. So that doesn't solve the problem. The only way to solve the problem is to raise the federal funds rate above the rate of inflation. If the federal funds rate is 0.25% and inflation by the CPI, which is half of what John Williams says it is, he says it's closer to 15%, we would have to raise the federal funds rate by 700 basis points to over 7% to just barely be above the stated rate of inflation. This is what Paul Volcker did in 1980 when inflation was running wild, raised interest rates to 20%, stopped inflation in its tracks. What would happen to the market if they did raise interest rates above 7%? The real estate market would implode. The stock market would be kneecapped, and the mother of all bubbles, the bond market, disintegrates. These are the problems that we are facing. And so is 2% enough to prick the bubble? Is pulling away the punch bowl, not pouring more money into equities and not pouring more money into mortgage-backed securities and treasuries, and in fact selling them, is that going to have a massive effect? So the market was expecting this to be in a linear fashion, not all at once. And the Fed is saying, well, no, by the second quarter into the third, we're going to do it all at once. We're going to taper. We're going to, in fact, actually stop buying mortgage-backed securities and treasuries. We're going to let rates rise, and we're going to, in fact, start selling off our balance sheet, dumping treasuries and mortgage-backed securities into the market, which will raise rates, which will then make all asset prices try to find an equilibrium, which they haven't been able to find in this environment, which will be much, much lower than where they are right now. Scary times, and that's for sure. And that's why when I talk about gold and silver, I've always talked about them as wealth, not as an investment, as wealth. And the period of time where all asset classes are all-time highs, and you're looking at an asset like silver, half of its 1980 high, below half of its 1980 high. There are very few asset classes on the planet that are as attractive as silver when you factor in the industrial aspect, thanks to you and Wall Street Silver and others, a rebirth, a renaissance in the monetary aspect of silver, and a green and digital environment that is expanding the applications so dramatically, and yet it's priced half of its all-time high. Its relationship to gold at nearly 80-1 when it's coming out of the ground at 7-1. You could argue it's 11 times undervalued. It's the value proposition, Lee, of a generation, and I say that with all sincerity.
Well, it sounds to me that is an investment opportunity. I know you say precious metals isn't an investment, but I think in this scenario that it may be.
Well, it's funny you say that. A client said almost the exact same thing to me today. And it is. But when you look at it as wealth that has lived through 2 world wars, German hyperinflation, the Great Depression, and every pandemic that ever was, and is still immutable wealth, to me, it is wealth. Wealth that very well could turn into the investment opportunity of a generation as well. There are very few things that offer what silver is offering in an environment where all asset classes, with the exception maybe of silver and gold to a lesser extent, are wickedly undervalued. And that is because gold and silver represent the canary in the gold mine. And this is exactly why that they have tried and doubled down their efforts to hold the price down, where people say, look, inflation's running wild and gold and silver aren't doing anything. That's exactly what they want you to think. At the same time, you see record acquisition by the money managers. There's one trader on COMEX right now that's long 40,000 gold contracts. That's all between $7 and $8 billion worth of gold that they are holding right now. You'd have to have an initial margin account of $350 million to buy that. That's why you see record deliveries off of COMEX. That's why you see record acquisition by the central and commercial banks.
Andy, what role do you see precious metals playing in one's portfolio from a risk management standpoint?
Well, I think even in the best of times, I spent 3 summers in Zurich when I was 19, 20, and 21. Our initial business was Swiss investments. And I met many Swiss money managers and bankers, and all of them said the same thing. In the best of times, you should have 10% of your assets in precious metals. And these are far from the best of times. I think precious metals represent the bedrock, the stability. If you envision your assets in the shape of a pyramid, the way the Swiss do, the base of your pyramid, which should be 60 or 70% of your assets, should be things like a paid for home or paid for real estate, not on margin and not lent against or with the mortgage. You used to be able to say cash in the bank, but it's evaporating at a minimum of 7% per year. But we can still throw that in there. In precious metals, the middle portion of your pyramid, I used to say treasuries, which would throw off a return. Well, those don't throw off a return anymore. So maybe utility stocks, paying a little bit of a dividend. And the top 10% of your pyramid would be mining shares and cryptocurrencies. The theory is you lose everything on the top 10%. You make nothing on the middle 20 or 30, as long as the base of your pyramid is not subject to massive speculation. You don't go backwards. I guess I would simply say to you and to everyone out there, you put enough in the base of your pyramid to stabilize everything else that you're doing above. And so in this environment, I think precious metals has never been more important. It represents the stability and the bedrock of everything that you own and of all of the assets that you have deployed.
You know, Andy, I had interviewed Ali Shahani probably about a month and a half ago, and he was living through a currency devaluation in Lebanon. And on top of that, the banks basically took all their money and froze it. So he had no access to cash, and he had a significant amount of money in cash. So, you say money in the bank used to be a solid investment, but, today's day and age, anything can happen. So,
well, and I would take the word investment out and call it a solid asset. And in today's environment with bail-ins, they wrote bail-ins into law for a reason. They also at the same time implemented gating into money markets, which is less known. And that is, well, I'll put my money into a money market. It's not really with the bank. But what happened was when Lehman and Bear went upside down, a lot of those investments in the money markets were with Bear and Lehman, and they started to go upside down, and money was being pulled out of the money markets at such a pace they were starting to go upside down. It's called breaking the buck. They also implemented gating, which means if the shit hits the fan, you're gated. You cannot leave. So when you talk about the risk of bail-ins and gating versus the return of a fraction of a percent, it's not worth it. And when I listen to my clients, the overwhelming comment that I get over and over and over and over again is, I want to do this immediately. I just don't want my money in the bank. So you're right. It's not a safe place to be anymore. And that's really kind of what I'm getting at, is where do you put your money? Do you put them into stocks or bonds or real estate at all-time highs, factored against all-time lows in interest rates? Do you put it into a bank when you get next to nothing in return for what amounts to a tantamount of risk in bail-ins and in inflation and in gating? Precious metals, to me, stand out above all else as a place to park your money as wealth. And that's why I call it wealth. It may perform like an investment, but in a world where valuations are very difficult to ascertain because of the monetary policy of the Fed, where asset prices have inflated. In Austrian economics, it's called the crack up boom, where misallocation of resources and capital create distortions in price discovery. Well, that's everywhere you look, with the exception of gold and silver. Because it is the canary, they are trying to quiet and muffle the canary. And those of us who see through that understand that price is a tool of misdirection. Price is not what we should be focusing on, rather the fundamentals behind the markets, which really are somewhat shaky, in fact, very shaky. And you can see that by what's coming out of the FOMC meeting, where they're telling you, hey, we need to normalize our balance sheet. And what that really means is we need to normalize asset prices, because if we don't, it will only get worse. And quite frankly, this all should have been done in 2008. And since then, they've only doubled down their efforts and created a problem that's even bigger. It's like a beach ball. When you hold a beach ball underwater, the further you push it down underwater, the faster and with greater fury it comes out of the water and up through the surface. It's a coiled spring. Mother Nature, mathematics, just like Father Time, will catch you. There is no way around it. You can manipulate it all you want, but in the end, the tab has to be paid. And I think that's really what we should be focusing on. It's not about return on your money these days. It should be return of it.
You know, there are two other areas I want to talk to you about. First, there has to be a difference in how a high net worth individual invests in precious metals and incorporates it in their portfolio, and how the average person wants to get involved in the sector.
Well, I mean, it's different, but it's the same. I mean, the rationale should be the same. The difference is in the size of the purchase, really. And, you know, the high net worth investor is less panicked right now than the average investor. And the reason is because of the Fed policy. What's the difference between the average investor and the high net worth investor? There's one word: assets. In the environment we are in, assets have gone crazy. So the wealthy have become exponentially wealthier, where the top 1% has more in assets than the bottom 50% does altogether. Where the bottom half, who's been facing wicked inflation, finds it harder to put food on their table as their grocery bills have doubled, finds it harder to heat their home as natural gas has doubled, finds it harder to pay for healthcare or gasoline to drive to work and back, or, you know, the evisceration of the small business, which, you know, with now that, like, for example, the laws in New York where small businesses have to be vaccinated and their employees, or you can't do it. You can't work. It's killing the small business. It's killing the small guy on the street. It's killing the average guy who is watching the cost of living increase exponentially, and they don't have assets that they can offset that with. So for the smaller investor, it's about preservation and getting out of harm's way. For the big investor, it's less about the panic of becoming so much harder just to subsist, to live, subsistence. It's more about watching the potential of all of these gains that they've made in their assets, which where the real inflation is in assets, dissipate. And when that money comes out of these really inflated assets and tries to find a place, you'll see asset price inflation in precious metals as well. Not just in consumable goods like we see right now, not just in stocks and bonds and real estate, but precious metals being one of the only places where you haven't seen wicked price inflation. Now, we've seen some, as premiums on everything are way up from where they always were, but you ain't seen nothing yet, because as Rick Rule often says, the average allocation to precious metals across the entire US financial matrix is less than 1%. Well, in 1980, it was 8%. The average, or the mean, over the past 40 years is 2.5%. That's almost a five-fold increase in demand, when as an owner of a precious metals company, getting material is the single most difficult thing that we do now. I'll give you an example. You used to be able to place a call and have $1 million worth of gold or silver on a truck sent to my warehouse within a day. We placed a $2 million order with the UK Mint in November. They ran out of blanks shortly thereafter. They've held my money the entire time, and we haven't received our product yet. You're talking 90 days of hedging, putting that money out with no return. And then once it finally does get into customs, running logistics on it. The Austrian Mint, same thing, placed a big order, and Omicron has ravaged the Austrian Mint. And so I haven't received that yet. The US and the Canadian Mint have been models of inefficiency. So getting product is really very difficult. Small coin shops in your hometown or anyone's hometown, they're dead in the water because no one is selling anything at all. And if you're not high up on the food chain and can spend millions of dollars, hedge it and run logistics for 60 to 90 days, good luck getting product. You will hear from people come on your show or listener comments, their local coin shops are out of product. And it will only exacerbate all the way up to the small companies in this industry, when right now getting physical product is as difficult as anything I've seen ever in 32 years of owning this company. So I think it will become a really polarizing and accentuating factor in 2022 as people wake up to the value found in precious metals. If we follow the extension of the Fed's comments and they let the asset prices deflate and crash, when that money comes out, as a good deal of it did in the last 2 days, seeing the S&P down 2.5%, that's money saying, I'm taking my profit and running. I'm taking them at their face value. Where does that money go? Does it inflate more consumable goods, or do they move into precious metals or cryptocurrencies? And that got hit on the head too recently. So where do you put your money when you come out of these assets that you doubled or tripled your net worth? Where do you put it? Into dollars that are losing value, into banks that can be bailed in, into equities at all-time highs, into the bond market at all-time highs, into real estate at all-time highs, or into silver or gold at percentages of their all-time highs with fundamentals that scream value. I think that's what will happen. And if we just saw a 2% or 2.5% allocation, the mean of the last 40 years, that's a five-fold increase, and it's game over for anyone who's late to the party.
Andy, how would you, once you acquire this precious metal, if you're a high net worth individual, where are you going to store it? I mean, do you recommend anything? Maybe overseas somewhere? I mean, do you have any strategy that someone could follow?
Well, we used to do a lot with Switzerland. I remember when the Swiss came out, right when FATCA, Form 8938, Treasury came out, or the IRS, they started with the banks before they went to the public here in the States, and they went around the world and went to companies like UBS and Credit Suisse and whatnot. And they said, you got 60 days to give us all the people or we're going to freeze your assets. So UBS and Credit Suisse and all the Swiss banks sent a letter to all of their depositors, many of my clients, saying you have 30 days to get out or we're turning you over to the IRS. I think that you will see things like this. You will see an environment where there's not going to be anywhere to go, really. And so I think big money is going to react, and they're going to react quickly and swiftly. And you can see that right now by the positioning all throughout COMEX, by the central banks, by the commercial banks. The biggest money in the world is getting in front of this because I don't know. I just think that they're trying to close the loopholes. They're trying to close the ability to get out. I don't know how it all plays out, Lee, but I'm telling you, I truly do believe that there are very few, if any, places you can safely park your money outside of precious metals, and I don't think it will last very long. I just think they're trying as hard as they can to make it very, very difficult to protect yourself and closing the windows. And just like they did in Switzerland, I think you'll see similar things here. So sending your money offshore may not be the best choice, because I remember when at the same time, Viamet in Switzerland kicked all US citizens out. We do have a program in Canada with Brinks, and I really do like it an awful lot. But here again, a lot of people think, well, Canada is a socialist nation. They don't like Trudeau, and they're afraid of that. I might disagree. I watched Canada sell their exposure to the Royal Bank of Canada here in the US, and maybe, just maybe, a country that is bordered by 3 oceans, doesn't piss anybody off, is resource rich, has the best banking sector in the world, surpassing Switzerland, is a good choice. But if not, we have worldwide exclusives here in the United States with Brinks. We have the only relationship with Brinks Miami. We have a Brinks relationship in New York, Salt Lake City, Los Angeles. Or you bury a hole and you dig a hole in your backyard and become a midnight gardener and hold it yourself. Counterparty risk in this environment will become more and more in focus as you see, if we were to see the Fed follow through with this, and you see a deflationary depression where counterparty risk becomes very real. Look at Evergrande, and people who own their bonds considered it an asset until they didn't perform. Well, there's your counterparty risk. So I've seen it before. I've seen, what was considered the best laid plans need to be reevaluated, just like those people who were in Switzerland and Viamet or in the banks. I think in a world of imperfect choices, Brinks Canada or Brinks US is really a good choice, but the best choice is removing any and all counterparty risk and holding it yourself. Look, you have a greater chance of being ripped off by the system, Lee, than you do by a burglar. It's different for someone like myself who owns a metals company. I'm visible. I'm out here doing shows with you and other people every day. I have no choice but to hold my metal in depositories. But for other people, remember, loose lips sink ships. Don't talk about it, hide it, bury it in your backyard, put it in under a floorboard or under insulation in the attic, or do whatever you need to do to be your own bank, your own 401k, your own annuity, and take the accountability and remove the counterparty risk from the equation. If you have no choice, Brinks is a good one. But here again, there are no perfect choices in this environment.
What do you think of safety deposit box? Do you think that's?
I don't. I think it's the worst possible place to put your money. In fact, Chase came out a year or two ago and sent a letter to all their depositors saying no cash or coin is allowed in safe deposit boxes. They're not insured. And if there's a banking holiday, you're not going to have access to it. There's all sorts of, you can Google it and find all sorts of reports of stuff being stolen from safe deposit boxes. I don't think it's a good choice. It would be the last place I would put it. And I think you're better off burying it in the ground than giving it to a safe deposit box at your local, Bank of America branch.
Oh, that's a good summary. I appreciate the information. I think our audience will appreciate it as well.
Absolutely.
What do you think about crypto in this current environment? I mean, I don't know if you got a chance to watch any David Morgan's series.
David's a good friend of mine. I have not seen it. I guess I'm the wrong person to ask regarding crypto. Simply speaking, I think that it's air, it's risky, it's new, made a lot of people very wealthy. I think I would caution people to thinking that everything goes to the moon and never comes back down. You can see, look, Bitcoin has lost a third of its value in a few weeks. It's got great volatility. Bitcoin enthusiasts would say, well, it's done that many times before and it's come back and it's only going to go higher. Maybe it is. I don't know. I have a hard time believing that the government will want competition in money creation business or in wealth. I know that they have begun to increase regulation. It's now on the 1040 form. As precious metals companies, we have been told that if the new tax bill passes, that we will have to issue Form 8300, which is excess cash when people paid in cryptocurrency above, $10,000. And maybe that's why they are hiring 75,000 new IRS officials for all of the people who have made a killing in crypto. And look, all I would simply say to you is that I've been wrong on my appraisal of crypto, and I am not too proud to admit that. I mean, I was wrong, and it was generational wealth that has been created. I just don't know that is the wave of the future. I know a lot of people believe that it is. I think maybe Bitcoin is here to stay, not as a currency, but as a store of value. But look at it this way: you had 11 countries meet a few weeks ago, simulating a global hack on the financial system. You had Fed Chairman Powell asked a question: what's the greatest threat to the US financial system? He didn't say inflation. He didn't say overvaluation at low interest rates of assets. He said a global hacking of the financial system. So you have 11 countries. And who was at that meeting? The same people who ran the simulation for viruses and pandemic in 2019, yep. Schwab, the Bank of International Settlements, the
World Economic Forum has
yes.
in the past 2 or 3 years a cyber pandemic simulation.
That's exactly right. So you see a electromagnetic pulse or whatever it is. It's a problem. So what do I think? I don't know. You see a lot of these countries that are running into chaos, and the first thing you read is that the internet was shut down. So what do I think? I think it's been an amazing investment, speculative investment that's made a lot of people generationally wealthy. Do I think that it's a smart place to put your money? Well, look at the pyramid analogy I gave you. the top 10% of your financial pyramid, where if you lose it all, it doesn't kill you, is the way to look at cryptocurrencies. You should have a position in it. And I have been proven wrong in that. But if you lose it all, you don't want to have an inverted pyramid where something new that, look, gold and silver, as I said, have lived through every world war and hyperinflation and every pandemic and the Great Depression, and they're still immutable wealth. Cryptocurrencies are just a few years old. And how does it play out? I guess that's anyone's guess. But when you see the most powerful people in the world run simulations on global hacking, and the Fed chairman says that's the biggest threat to the financial system, you got to listen a little bit and maybe mitigate your exposure so that if something does happen, you're not too heavily positioned in that one asset class and it kneecaps you. And that could happen.
It's definitely a risk you want to avoid or actually prepare for.
Right.
Just one last question. Do you have any insight into tax risks regarding precious metals?
No. I mean, in terms of tax risks, the only tax risk is that if you sell it and don't declare it. And precious metals are one of the few things where most of what you would sell carries no dealer reporting requirements. Some things trigger it. Most don't. A lot of people probably choose not to alert via the honor system, their accountant, by extension, the IRS, that they sold off a bunch of precious metals. Don't play that way. In fact, that's why I think the IRS is hiring all these officials to go after people in cryptosphere who have gone from one cryptocurrency to another within the sphere, switch from Bitcoin to Dogecoin to Litecoin to Ethereum or what have you, and don't declare it. Those are sales and repurchases. Those all should have been declared as a sale and a purchase of a new asset. And when the IRS audits you and that person, and they say, well, I see here you initial deposit to Coinbase was 10,000 and here you're taking out 75,000, but the numbers don't add up. How'd you get there? There will be a stiff price to pay. Same thing could be true here. Precious metals are one of the few private investments left. A lot of people believe that the way that they will go after the precious metals market is to initiate a wealth tax, where when you sell it, you're taxed at a very high rate. That's the only thing that I can think of off the top of my head. But if you never sell it, there's never any reporting or never any tax issues. If you do, in theory, you could sell it for cash to a local coin store and never tell anyone. Is that smart? Probably not. Do people do it? Probably so. You sell a large amount, get a check or a wire into your account, you are really playing with fire by not reporting it. And I would tell everyone, just because we are not obliged to report on your behalf does not mean that you shouldn't. And I think in an environment where the Fed is looking and the government is looking at people doing these kinds of things in this environment, they'll be looking for this. So I think it's less a tax risk and more a personal risk, a choice, if you will, of not playing by the rules. Look, profit's not a four-letter word. Pay your taxes. It sucks. Pay them and don't look over your shoulder. Sleep well at night, because peace of mind and sleep at night by far is the most important asset you can own. And you'll realize that when you get the letter in the mail saying you're being audited, and how do you make A and B connect when you've gone from A to B to C to D to E to F inside that sphere where no one knows about it until you come out and you get questioned about it. And that, to me, are the types of risks that we would face, not only in cryptos, but also in precious metals, for people not reporting their gains when they sell.
Very sound advice, Andy. I appreciate it. Thank you so much for joining us here on Risk, and love to have you back a couple months.
Yeah, and one last thing, Lee, I would like to say this. Any of your listeners who would like the best price in the country on precious metals, that'll be my promise to you. All they need to do is send an email to us at info@milesfranklin.com. We will send you a new price list that we produce every week. We'll make sure your listeners get the best price in the country. That is my promise. We are building a new website, which will be done, I'm hoping, at the end of the first quarter. We had to scrap the one that we were already doing because of problems on the back end. So we're old school. We don't do things online yet. But I will tell you this, we will not be undersold. And we're probably the only major precious metals company in America that's licensed and bonded in what is a federally non-regulated industry. After 32 years of never having a customer complaint, being US Mint representatives, the licensing and bonding is what really differentiates us from everyone else. So we would love the opportunity to assist your listeners. Send an email to info@milesfranklin, put risk in the subject line, and I will personally make sure that their questions are answered, that they get an up-to-date price list, and that we will beat or match the lowest price from any major retail company in America, out of respect to you and out of gratitude for coming on your show. And I do very much appreciate it.
Sure, Andy, and I'll put all that information in the description of the video as well, so people will have.
Fantastic. Fantastic. So yeah, I'm always here. If you want to jump back on, let me know. In the meantime, very happy and healthy New Year to you and everyone out there. And I wish you and your new endeavor nothing but the best of success. And I know you'll kill it.
Thank you so much, Andy. Take care.
You too, my friend. Thanks, Lee.